Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to the Physician Sense podcast and YouTube channel from the studio, also known as Chad's house and Tyler's house. We're coming to you live. And we got a fun one today. One of the most favorite topics of the physician community, also for Tyler and I, the Backdoor Roth IRA. So we want to hit some things to keep in mind, some of the errors that we see, tell you that it's not that complicated, right? They gave it this crazy term, but it's not that crazy. It's pretty easy to pull off. So Tyler, welcome, my friend. One of our favorite topics, a little jam session here on just backdoor Roths. What do you have to say about the backdoor Roth? When I say the word backdoor Roth, what comes to mind, my friend?
Something nefarious and evil. Truthfully, it is a whole bunch of foolishness. But, it's just a way to create tax-free growth on some of your excess savings. That's all it is in the end. And it's not like the biggest deal in the world. Like when you actually look at a financial plan trajectory, it's fine. It's good, but it does get a lot of attention. I think mainly because it feels like you're doing something wrong. And I think that's why it's gotten a lot more attention, and it is beneficial, but it's just not as big of a deal as it sounds at the outset. But what we want to do is we want to walk you through how to do it. Now, you might even do this while you're in training. If you're filing your taxes separately due to student loan management, you may very well be doing it the year of transition because you don't know if your income is going to be exceeding the thresholds of a direct Roth IRA contribution. And in all likelihood, as an attending physician, that is the position where you would be making these contributions. But essentially what it is that Roth IRAs are a savings account that you can invest in. And most people can do this, but if your income, if you have the thresholds at the top on mine, let me know. But I think they're like $146,000 as a single person and like $230,000 if you're filing jointly, household income. And
yeah, you nailed it. Yeah, 146 on the Roth and 230 for married filing jointly.
Cool. I'm glad my brain's working on that at least.
You nailed it. I need my cheat sheet. You're better than I am.
So if your income is above those limits, then you cannot contribute directly to this type of investment account. What you have to do instead is, instead of putting the money into the Roth IRA directly, what you do instead is you will open up a traditional IRA, put the money into the traditional IRA account, and then a few days later, you will convert it or transfer it to the Roth IRA. That's why it's called the backdoor, because there are no income limitations on traditional IRA contributions. And there are no income limitations on traditional IRA to Roth IRA conversions. It's just that there are income limitations on direct Roth IRA contributions. That's why I say this is a whole bunch of foolishness, because it is perfectly legal, but the tax code makes it, you can't do the direct contribution if your income is above those limits. So it's an extra step that you're having to take in terms of like cash flow movement, but there's a couple of things you have to watch out for. Yeah, one of them is like you can't have any assets, right? In like the various IRAs. Which are they? They're the traditional IRA. What else?
Yes. They give it. So this is the Pro Rata Rule.
Right.
It's your regular IRA, traditional IRA, simple IRA, and the one that usually catches most people off guard, the SEP IRA. So those are the three that can throw this off. That's why I think this topic is so popular too, because it's something that we all want to do, but it's one that most people could have one of those accounts, especially in the physician world. Like the SEP IRA is very popular, but it's one of those ones where, and we won't go into the whole rabbit hole of this one too, but a solo K acts the same way as a SEP IRA. But it's not uncommon for a lot of accountants to say, just go open up a SEP IRA to lower your tax bill because it's easy. In defense of the accountant, they're probably not thinking about the backdoor Roth IRA as well. So yeah, the Pro Rata Rule is one of the most important ones. So if you have a traditional IRA, a SEP IRA, or a simple IRA, those need to be cleaned up. And it's not a difficult thing, right? You really just need to move those balances likely into your current 401k or 403b Or if you have some 1099 income, you could put them into a solo K, and that will clear up the basis issue we'd have here. But there's a form in there called the 8606. This is one of the most commonly missed tax forms out there in defense of accountants out there. Usually it's because they didn't know that you were doing a backdoor Roth, but this 8606 can become a hot mess relatively quickly. But yeah, that's the pro rata rule. That's one that should be very high on your list of things to keep an eye on.
Yeah. And if you are in the situation where you've made SEP IRA contributions, it's not like even if you are planning on doing the backdoor Roth, like there's one particular person I'm thinking of, she's going to be doing the backdoor Roth contribution this year. We also just assisted her with making a SEP IRA contribution. But it's because we know that as the year progresses, we're taking the time to create the solo 401k plan, and we didn't want to rush it. Like we were leading up into tax season. Sometimes you run out of time and you're like, I don't want to rush making a 401k plan. Let's take the time. Let's just get the deduction with the SEP IRA contribution. We know later on in the summer, we're going to open up a solo 401k. We're going to structure the plan the way that we want it to. And then we're going to transfer the SEP IRA money into the solo 401k. Because it's not that you can't have the SEP IRA money and do the backdoor Roth in the same year. It's that by December 31st of this year, that SEP IRA needs to be empty. Traditional IRA needs to be empty. Simple IRA needs to be empty. So as long as you meet that deadline, you could do the backdoor Roth right now while having a SEP IRA. You just have to have a plan of where that money is going to go. Make sure that there's a clear path to it. Yeah.
And if you're listening to this and you're like, I had $6 on 12/31. It's okay. Believe me, we get it. We do 2 or 3 sweeps per year. Before we only had to do 1 sweep per year because there was no interest, but now there's decent interest on these cash funds, these money market funds. So that does not ruin your backdoor Roth. Don't say, oh my gosh, I'm amending taxes. You'll just get that cleaned up on the following tax year. But you don't want like the $100,000 or the $50K or the $2 million balance in your IRA. That's not as simple as, I'll just get it cleaned up at the end of the year, right? If you're keeping those pretty much zeroed out at the end of every year, you're fine here. A couple bucks of interest show up. But that's one of those ones where, we have some YouTube videos on this topic, and this topic's always a very popular topic. And, we'll get that question like 30 times. Like, I had $4. Do I have to redo everything? Like, no, we're okay. Take a deep breath. You'll get it cleaned up on the next one. You're good here. I have a fun one for you, Tyler, because I actually saw one of your tweets, and I think this is one that we have different perspectives on. And I'll add to this in a second. There's a lot of ways to take this one. So the other funky rule is called the Step Doctrine, which just to add more complication to a thing that could be resolved by just saying, hey, there's no income limits on Roths, or put it really high. But again, talk to your congressman, your congresswoman. That's not us. Don't yell at Tyler and I. We just follow the rules. That's all we do here is we follow the rules. But the Step Doctrine says, how quickly can you move it to the IRA, to your Roth, while making sure the IRS still blesses your tax return? What's your theory? Or process, I should say.
I need to find the reference. There was communication about this from the IRS. I think it was when they were toying with the idea of getting rid of the backdoor Roth. Was it at the end of 2022?
I think it was before that. I think everything just feels like it's mixed together now. But I think it was a few years ago at this point that we almost lost them.
I think that when it ultimately was not lost, that it was affirmed somewhere that they do not view the backdoor Roth as a Step Doctrine violation. Like that they're not looking at that. They have fully legitimized it as like we know people do this and it's fine. So my theory, and I wish I had the reference right now. I'll have to look it up and share it with you. My theory is that it's not an issue at all.
So here's where I once was always do it pretty much the next day. Once the cash settles, do it. I think Dr. Dolly, White Coat Investor, has always said that too. And his theory was always, someone show me where this is going against them in an IRS audit, right? What you're referencing, at least what I think, is back when that was all maybe getting removed, was they came out and said, like, we know people are doing the backdoor Roth. We're okay with it. We know it feels like you're breaking the law, but you're following all the rules. And I vividly remember this because I was on a plane ride out to California for a financial conference. And I did, in our industry, Michael Kitces is like the biggest financial nerd out there. So he had a really good webinar on just backdoor Roths. And he gave three good examples. One was Michael Kitches. One was Ed Slott, who, again, very into the weeds nerd here in our industry. And I forget who the other one was, but pretty much they all had different steps. One was a month, one was a quarter, one was waiting an entire year. And these are all very big names in the financial planning industry. And most of them had pretty high up tax designations. So that, I don't want to say it scared me, but it made me think like, oh, all right. Now, we didn't go quarterly or annual, but I will say this backdoor Roth season, which I call it Backdoor Roth IRA. It's usually like January 3rd or 4th for all of our clients, where we just do like a mass backdoor Roth IRA day. But this was the first year we did wait an entire month before we did the conversion. So we did put one in there. And I think it might have been Michael Kitches that said he liked the idea of a month because it would be two separate statements. One statement would show a balance on an IRA, where the next statement would show the balance on the Roth IRA. So you could show a step in there. But to your defense, no, the IRS has never given full context unless you can show me what you were referring to there, where they're saying like, how can you say a day is not a step? So we did a month for the first time, but I saw your tweet on there that said just kind of do it like the next day or whenever the cash would settle, which was always our theory too. Yeah. Now, this year I got a little bit of a cold shiver down my back and I said, you know what, let's just put at least a month in there. And it was a little bit easier saying that this year too, because we do a lot of our custodian work through Fidelity, and a lot of the cash accounts were right around, high 4s or 5%. A lot easier telling clients to sit at 5% as opposed to sit at 0, last year, 2 years, 3 years ago. So that also made the decision a little bit easier. But yeah, I made a little bit of a pivot this year. So we did add a little bit of a month in there. It's funny because when we sent out the email to all of our clients, they're like, why the change? I'm like, wish I had a good answer for you. Got a little bit spooked, heard a few different people say a few different things. We're going to add a month in there. But that's where I was. But if you can show me something else, I think it'd be a little bit easier to go back to the short term. But the month wasn't too bad. We had a good system in place.
Yeah. I mean, it's not going to be the worst thing in the world, like to build in that cushion. So if it makes you feel like more comfortable just making that delay, there's nothing wrong with it. I'm going to find this today. Because now I was even just looking right now to see if I could find it, but it's not on my fingertips. But yeah, we'll confirm.
Yeah, if you track it down, we'll put it in the show notes too. So then everyone else will have full closure on it.
Okay.
Yeah, but I was like thinking when they said a year, I was like, man, a year is a long time.
Yeah.
I mean, you could really argue, are they keeping it in cash for an entire year? Do they invest it for an entire year? Which then comes all the way back down to like the physician community where, most people don't backdoor Roths have to be high income. So you would think it affects everyone. Yeah. But now you're getting, the difference between your 7,000 and whatever you end up converting over. That's all taxable. So you can go down so many different rabbit holes there. So we thought a month felt okay to be the proper spot there. But like I said, for every year before this one, literally every year that we've done those, we were always put the money in, cash settles, 2 or 3 days at Fidelity, and then we move it right over.
Yeah. I'll get on that. Yeah, I'll let you know. But anyway, yeah, these are the basics of the backdoor Roth. If you've not done it before, I think that it is worth it either to take a significant amount of time to read about the steps from a contribution standpoint, the rules that we talked about, the Pro Rata Rule, and then make sure that you invest the money once it's in the Roth IRA. Don't just leave it in the money market fund. But then adding in Form 8606 on your tax return is an additional step. I think it's wise for many people to outsource this. Even if you're not working with a financial planner, working with an accountant in which you communicate to them, hey, this is what I'm doing. You can navigate through like Free Tax USA or TurboTax with the backdoor Roth, but the wording, the way in which it's communicated, it can be really confusing. So I think that even like for the first time, before you do it, like maybe get some help doing it. But after you do it, I think a lot of people realize they're like, wow, this is not that complicated. So it's a good way to create some more tax-free savings. And now you know how to do it.
Yeah. And the 8606 is one where if you're doing it right, that's the first time every year, like it's happening intra-year. 8606 is a pretty simple form. The 8606 is very complicated when you were doing like past years of basis, or you did the contribution somewhere between January and tax filing for the last year. Not to say that you can still do it on your own here, but I couldn't agree more. I mean, this is one where just bring an accountant, because heaven forbid you make an error, right? They have insurance in place to at least cover your taxes and penalties if they made the error. Mm-hmm. And if they know how to do it, they're likely not going to make an error because it's not that complicated to form. Just make sure you tell your accountant that you did it too, because most of the time we think at our current ages, like and your accountant thinks the same thing. The last thing that's going to produce a 1099 for you is your IRA, because they're going to say, you're 30 or 40 years old. Why are you touching your IRA? So if you've never done one in the past and it's your first year, just make sure you tell your accountant, hey, I did this backdoor Roth. Hopefully that makes them trigger to say like, oh, you probably have a 1099, get us that. But keep an eye on that. That's one it's just missed a lot. And I think it's more or less because we didn't know the proper forms to upload to the accountant. So Backdoor Roth, fantastic tool. One of my favorite, I would say my favorite part of the Backdoor Roth is you're not wasting any pre-tax dollars. And that's where I think the Backdoor Roth is really powerful in the long run, is you're not wasting anything. Now, only time will tell, as Tyler joked at the start, how valuable really was it? Time will tell, but you're not wasting anything pre-tax, which is why we love that Backdoor Roth. So always fun when we can chat about Backdoor Roths here for an entire episode. If you have questions on the Backdoor Roth, or you have some unique scenario, because everyone does, send us a note on the website in the questions, or drop it in the socials. But Tyler, talking about Backdoor Roths with you, man, that was a beautiful day for me. So I appreciate it. Anything I'm missing?
No, I think you covered it all. Hope you enjoyed the day. It's sunny here. I'm sure you probably get a lot of sunny days down there, right?
Yeah, it's one of the reasons why we moved to Florida. So beautiful sunny day as well. But you enjoyed up in the Northeast. I know that they don't come as often as in Florida, but still beautiful weather up there as a man from the Northeast myself. So I'll catch you on the next episode.
All right. See you.
All right. See you, Tyler.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state-registered investment advisor.